Let's dive right into this explainer, because today we're looking at how a ripple in one part of the globe instantly becomes a massive wave in another. Welcome to our breakdown of August 25th, 2026. We're going to connect the dots between international trade, your wallet, the tech shaping our future, and honestly, the sheer forces of nature. It is all totally intertwined.
We have to start with this massive figure, $20 billion. That is the exact value of American products, think steel, think fish, that Canada just hit with retaliatory tariffs. It instantly hooks us into the sheer scale of today's economic tensions. We're not just talking about political posturing here. This is real money, directly affecting businesses and communities right across the border.
So, to make sense of all this dense news, we're unpacking it across four main themes today. First up, trade wars and global conflict. Then, energy, inflation, and markets. Third is the artificial intelligence economy. And finally, health, weather, and the workforce. Kicking things off with Section 1, Trade Wars and Global Conflict, specifically sanctions, tariffs, and choke points.
We are watching a really intense trade standoff unfold between the US and Canada. On one side, Washington is threatening a massive 50% tariff on Canadian vehicles and auto parts. And on the flip side, that $20 billion retaliatory strike from Canada we just mentioned? Economists are already sounding the alarm that this specific dispute could seriously disrupt supply chains and spike prices on both sides of the border. It makes business investment incredibly uncertain, and ultimately, it puts the squeeze right on everyday consumers.
But these economic weapons are being deployed globally, not just in North America. Take the Strait of Hormuz, for example. Because Washington warned that countries trading with Iran could lose access to the U.S. dollar-based financial system, traffic through this critical maritime choke point is basically ground to a standstill. Only 2 tankers reportedly passed through on Monday, and you can see the collateral impact immediately. The UAE suspended transactions, which completely disrupted India's export of rice, tea, and pharmaceuticals to Iran. You add in the tragic reality of Russian missiles striking Kyiv, and you really get a sense of just how fragile the global system is right now.
That brings us to Section 2, Energy, Inflation, and Markets. This is where geopolitics literally meets the ticker.
Now, all this creates a genuinely fascinating market paradox. With everything happening in the Middle East and that major bottleneck at the Strait of Hormuz, you'd probably expect oil to just skyrocket, right? But amazingly, oil prices actually dropped over 3% today. Brent crude settled at $88.58 and West Texas Intermediate at $82.36. Why? Well, traders basically calculated that Washington's economic sanctions were actually less dangerous to the global supply than a renewed military escalation would be.
And that drop in oil, it triggered a massive domino effect. Cheaper oil means inflation fears start to cool off. When inflation cools, it takes the pressure off government bonds, which push the 10-year yield down to 4.63%. And cheaper borrowing makes stocks look much more attractive to investors. So that lifted American equities across the board. The Dow added 160 points, the S&P and NASDAQ both climbed, and we even saw Bitcoin surge to briefly test that $80,000 mark before settling around $79,237.
But, this is exactly why we always have to look beyond Wall Street, because Main Street is telling a completely different story. Everyday consumers are still feeling the heavy pinch of gas staying over $4 a gallon. That sustained pressure led to a sharper-than-expected drop in consumer confidence this month. People are getting worried about their household spending, and that fear directly hit retailers today. Just look at Dick's Sporting Goods. Their stock took a record 30.7% nosedive after they lowered their profit forecast. It's a really stark reminder that macroeconomic winds don't always reflect what's actually happening in the consumer's wallet.
Moving right along to Section 3, the artificial intelligence economy, or what I like to call the high-stakes bet. Despite this massive tech-driven rally in the stock market, public sentiment is still deeply divided. A recent Pew survey actually shows that 40% of American adults expect AI to cause more harm than benefit over the next 2 decades. And this isn't just some abstract fear. Platforms like OpenAI's new ChatGPT for teens are facing really heavy scrutiny right now from parents and regulators who are demanding stronger youth protections. At the same time, companies like Meta are actively defending themselves in child safety trials over their engagement algorithms. So with the public feeling pretty skeptical, the business world is asking one absolutely critical question. Are these massive AI investments actually going to pay off? Corporate tech buyers aren't just blindly buying into the hype anymore. They are actively demanding measurable, concrete returns before they greenlight any more infrastructure spending.
Basically, the honeymoon phase of AI investment, it's over. It's time for the technology to prove its everyday financial worth. To really put the stakes of this into perspective, $220 billion. That is the amount of debt American tech companies have issued in 2026 alone, just to finance their AI expansion. The U.S. also attracted almost $286 billion in private AI investment last year. So they are heavily borrowing against a future they believe AI will build. It is quite literally one of the most expensive technological bets in human history.
And that brings us to the ultimate scorecard for this massive bet. All eyes on Wall Street are completely fixed on this week's tech earnings. The absolute centerpiece is Wednesday's NVIDIA report. Analysts are expecting their quarterly revenue to approach an unbelievable $92 billion. If NVIDIA, along with other heavyweights like Marvell Technology and Salesforce, can actually hit these targets, it'll prove to the market that corporate demand for AI infrastructure is real and, more importantly, sustainable.
Finally, let's look at Section 4, Health, Weather, and the Workforce. This is all about the human element.
We're seeing a really fascinating workforce paradox unfold right now. On one hand, automation is actively absorbing routine jobs, which led to roughly 120,000 tech layoffs across 228 companies earlier this year. But on the flip side, building the physical infrastructure for that exact same automation is creating massive new demand for physical trades. The explosion in data center construction means we suddenly have a surging need for electricians, engineers, and cooling specialists. Turns out, the digital revolution actually requires a whole lot of manual labor.
Meanwhile, human judgment and basic physical resources are still absolutely essential during global crises. Take the ongoing Ebola outbreak in eastern Congo. The response totally relies on 4 critical, human-driven steps: vaccination, isolation, contact tracing, and protective equipment. But the workers on the ground are out there trying to execute this incredibly complex plan while facing unpaid wages, severe staff shortages, and just sheer exhaustion. Technology can map an outbreak, sure, but it still takes a human being in protective gear to actually stop it.
We are also seeing the limits of human endurance being tested by extreme elements all over the globe today, from a brutal 105-degree heat warning in North Texas to the Hawk Fire devastating homes near Reno, to flash floods in Hawaii and severe earthquake aftershocks in Indonesia. But here's where all these topics kind of connect back together. Scientists are now relying on machine learning and supercomputers to process the data from these exact events, hoping to dramatically improve our disaster models and infrastructure resilience in real time.
Looking ahead to the rest of the week, I definitely want you to keep this timeline and these critical economic catalysts on your radar. Wednesday is massive. It brings us the Fed's preferred inflation measurement right alongside that highly anticipated NVIDIA earnings report. Thursday brings Marvell's earnings, which will give us even more data on semiconductor demand. And Friday culminates with Fed Chair Kevin Warsh addressing the Jackson Hole Symposium. These events are absolutely going to set the tone for the markets and the broader economy in the weeks to come.
So we've covered trade wars, plunging retail stocks, a multi-billion-dollar AI bet, and the extreme weather that's testing our physical limits. It all connects. So I'm going to leave you with this. In a world where a tariff in Canada or a brand new data center in the US can fundamentally shift the global balance, how are you preparing for tomorrow? Thanks for exploring this explainer with me today, and keep asking questions.